I'm going to talk to you about the four main types of retirement income. Even though they're separate choices with their own nuances and caveats, they all interact together. It's important to really understand the ins and outs of each. Making the wrong decision can literally mean leaving hundreds of thousands of dollars on the table, and I don't want that to happen for you. And I'm sure you don't want that to happen for yourself. Let's get into some quick disclosures. This video is not financial advice. It's just education. I'm not here to tell you which decision to make about which income option. Investing always involves risk, including possible loss of principal. And be sure to check out any other important disclosures that I have below in the description. Moving on, the first part that we're going to talk about is the most widely known part, Social Security. I'm sure you've heard of that one. That is retirement income option part one. Where we'll start here, the earliest you can withdraw and file for benefits is age 62. The latest is age 70. You could actually file after age 70, but it doesn't make any sense because your benefit won't increase. So no one does that. The most common question we get asked is, when do I file? What makes the most sense? Helpful information on making this decision is that your benefit increases by about 8% per year compounding for each year you defer taking benefits. That means at age 62, if your benefit was $2,000, then at age 63, assuming you aren't working and earning more credits at that time, would be $2,160, assuming I did that math correctly. So that's the main thing to know, is that's a pretty substantial compounding increase. And the question is, do you think you'll do that in your investments? And that's something I ask people a lot, because if not, then it might make sense to just put off taking Social Security benefits. And assuming you have enough in your portfolio and your retirement savings to justify it, live off of those. If you're a very conservative person and you don't want to take a lot of risk, then 8% is going to be very hard for you to get. Take that into account. Also take into account family history or longevity. We have a client who said that her mom lived to age 100, her grandma lived to age 100. She feels like the same thing is going to happen to her. Then for her, it probably makes sense to defer as long as possible, because over her lifespan, it's more likely that she will get more overall by deferring, to the tune of hundreds of thousands of dollars, than if she took benefits at age 62 and continued those over her lifetime. There's no perfect answer here. What works for someone's situation is not necessarily what's going to work for yours. To be eligible for Social Security benefits, you have to have about 10 years of working history. These don't have to be consecutive either, just 10 total years. Another thing to know about Social Security is spousal benefits. A spousal benefit essentially says that one spouse can get up to 50% of the other spouse's Social Security benefits. One common thing that we see is one spouse will have a much higher benefit than the other spouse, either because the other spouse worked only part-time or maybe even didn't work at all outside the home. Another important thing to know is that after one spouse passes away, the other spouse continues the higher of the two benefits. If you file and you are collecting $2,000 and your spouse is collecting $1,000 and your spouse passes away, that $1,000 benefit goes away with them. If you pass away, however, your spouse will begin receiving your $2,000 benefit, but their $1,000 benefit will go away. So it's always the higher of the two benefits that gets continued on the passing of one spouse. Unfortunately, Social Security is no longer, as of the past several decades, a completely tax-free income source like it used to be. Now, the way it works is up to 85% of your Social Security is potentially subject to tax. How much is subject to tax is based off of something called provisional income, which I won't get into the details of here, but essentially they factor in your other retirement income sources in determining how taxable your Social Security by itself is. So if you make too much, you're probably going to be at the higher end of the taxability range of Social Security. If you don't make much outside, you have a tiny little pension or something like that, then it's possible your Social Security could end up being tax-free, although you really wouldn't be making very much money if that happens. One thing that comes up a lot is the Social Security Trust Fund and the future of it. There are a lot of younger people that I've worked with over the years and have talked to that don't want to factor in Social Security at all into their retirement because they don't believe it's going to be there. And I think that's a mistake. And the reason why I think it's a mistake is because the Social Security Trust Fund funds about 1/3 of retirement benefits. The other 2/3 is funded from payroll tax deductions. While I do foresee Social Security changing, I think it inevitably has to. I just don't know exactly how. I don't think it's going to go away entirely. And I think it's being a little bit too conservative to assume it's going to. Obviously, I don't have a crystal ball and nobody knows the future for sure. But that's just my opinion. And I would guess that most advisors probably agree with that. So retirement income part two is pensions. So unfortunately, this doesn't apply to a lot of people anymore these days. And I say unfortunately because it's essentially a guaranteed income source in retirement that's in addition to your Social Security. They can be federal, state, or private. If they are a state pension, then they might go by the name, for example, in Pennsylvania, we call it SERS, or if you work with the school districts around here, we call it PSERS. In Michigan, they call it MERS. On a federal level, they call it FERS. Are you noticing a pattern? They all rhyme. Basically, these have gone by the wayside because people are living longer than when they were designed. And so as a result, more and more has to be paid out from them. What happened when people started living longer is pensions started having trouble keeping their promises to the retirees. Seeing what was happening to some pensions around the country, a lot of companies with pensions decided that they were going to freeze the existing pensions that they had. If you were employed with them and you were offered a pension when you were hired, you get to keep it, but it will no longer grow as if you were contributing to it. New employees with your same company, when they come in, it's just not offered to them at all. If you had one, it didn't completely vanish short of solvency issues. That's not what I'm talking about here. What you would have noticed then is obviously you can't completely count on that. Now you have to contribute to a 401k and you have to count on that as a separate resource. So I just had a consultation today with a person who is trying to decide which pension income option she's going to take for her spouse. There's multiple different options depending on the pension plan. Sometimes there is your life only and you pass away, no one gets anything. Sometimes there's your life only, you pass away, the spouse keeps getting exactly what you're getting. And then there might be one where the benefit is reduced by 1/3 after you pass away. This is the spouse gets 2/3 of your benefit. You'll notice with each one of these, when you look at a pension projection and payout projection, you'll notice that there's trade-offs with each one of them. Most money you can possibly get per month is if there's no death benefit whatsoever. But almost no one does that because they don't like the idea of getting their first month's paycheck and then passing away and having the company keep the remainder. Almost everyone, in my experience, selects some type of death benefit. The outliers to that would be if two spouses have a pension. I've seen that happen where they both take the maximum benefit, knowing that they will be fine if the other one passes away. Or in some cases, someone will have their own life insurance. So they might have enough life insurance to look and say, my spouse will continue getting 10 years worth of pension payments if I pass away. Let's just take the maximum. They can invest it and that'll be fine. So again, there's no right or wrong choice for any of these. It's a complicated decision. It's just important to know all the facts before you make a decision. I also didn't talk about lump sums. A lot of pensions I've found, especially frozen pensions, are lump sum only. That means there's a lump sum that you can roll out at retirement and that's it. They might give you an option to receive some type of payment plan, but it's not directly through them. It's through some third-party insurance company that provides you some type of annuity. A lot of times it doesn't come down to selecting between a lump sum and a monthly payment. It just means that if you take a lump sum, you will still receive a monthly payment. It's just going to be lower. And sometimes that trade-off is worth it. It just depends on your goals. So retirement income part 3 is probably the most basic one, and that's just withdrawals from your retirement accounts. While this might be the most basic one, it is certainly not the simplest one because now the risk of making your money last for the first time, unlike Social Security and pensions, is totally up to you. If you're watching this and you're thinking, nobody taught me how to know how much I'm supposed to take for my investments, you're absolutely right. And historically, retirees have not really had to worry about that. It's really not until recent history that they have. I have a whole video on determining how much you can withdraw from your retirement accounts safely without running out of money. I will say that there is no surefire guaranteed safe withdrawal rate, as in this is 100% always going to work no matter what. But there's been a lot of research done to determine through historical market cycles what amount you can withdraw and survive even some of the worst case market scenarios in history, such as the Great Depression and the Great Recession, and still not run out of money. But yeah, check out that other video. It's right here. And I think you'll find that very enlightening if you're trying to determine how much you should take out from your retirement and make it last for the duration of your retirement. From a taxability standpoint, it's taxed like retirement income if it's coming out of an IRA. If it's coming out of a Roth IRA, then it would be tax-free. But if it's coming out of an IRA, that means it's subject to federal income tax and potentially state income tax, depending on the state you live in. There are a handful of states that don't tax retirement income, including my state, Pennsylvania. And I know Florida is another common one that doesn't. There are additional states on top of that. The other thing to know about withdrawing from a retirement account is just because you're retired doesn't mean it no longer makes sense to continue holding stocks in your retirement account. You might not be able to take on as much risk in retirement, but keep in mind that you still need your money growing for you. You don't need maybe as much growth as you did while you were in your earning years, although everyone would like it. But now that you're withdrawing from your account, it's important to avoid big swings in your accounts, especially if you're withdrawing a higher percentage from your accounts. The key with doing this is to strike the right balance between potential appreciation of your retirement funds and the fluctuations you will inevitably see. Also, don't forget about RMDs, or required minimum distributions. You must begin withdrawing from your retirement accounts. For most people, that's age 73, whether you need the money or not. So retirement income part 4 is annuities. So how these work is, in exchange for a lump sum of money, a life insurance company will offer you lifetime income. How much you'll get depends on a few things. For example, it depends on your age. It depends on the amount that you're rolling into an annuity. It depends on current interest rates in the market. There really are a lot of factors that go into it. How it's taxed is similar to other types of retirement income. If you buy an annuity with retirement money and withdraw it, then it would be taxed as retirement income. So it's taxed just like any other retirement income. If you purchase an annuity with a Roth IRA, then payments are tax-free. And if you use neither an IRA nor a Roth IRA, say you just put in money from a CD or some type of deferred annuity you've had for years that's accumulated, then what you're going to get is a combination of the money you put in back and the interest. It's going to be neither fully taxable nor tax-free. It's going to be somewhere in between. Since annuities are a polarizing subject, what I would also say is don't avoid annuities just because someone else says to. Many internet-based, and I hate to say it, even professional opinions are totally misinformed and even completely wrong on this subject. The most common flags for annuities are that they have high fees and that the salesperson gets a commission. And this is true. There are some annuities that have no fees and the salesperson gets no commission whatsoever. The bottom line here is not to listen to the fear mongering, but also don't buy an annuity unless you're absolutely sure how it works. That's how people get in trouble with unnecessary fees and money they can't access as easily. There's no right or wrong way to file for Social Security. There's no universal best option to select when it comes to your pension. There's no perfect amount to withdraw from your investments. And it totally depends on a variety of factors whether or not it makes any sense to include an annuity. The bottom line is that your goals are unique, and this is absolutely the last decision you should leave to a rule of thumb. Before you decide, understand what your goals are, what your time horizon is, and talk to a financial planner so that you don't potentially leave hundreds of thousands of dollars on the table. Thank you so much for watching. Please don't forget to like and subscribe and share this video if you found it helpful, and I will see you in the next retirement video.